Hello, and we are in Module 3 of the FX series. And now we're on topic 2, where we're talking about futures contracts. And here we're going to be looking at what is a futures contract. So, similar to an FEC, a futures contract is basically where two parties agree on an amount, a currency, an exchange rate, and a settlement date for the future. And then there is an exchange. But unlike an FEC, there's no exchange of foreign currency. There's only settlement in rands. But we're going to talk more about that in later slides. So futures contracts are standardized. They come in denominations of 1,000 units of a particular currency. So if you want to buy dollars, each contract is worth 1,000 US dollars. So if you wanted to buy $1 million US dollars worth of contracts, you would need to buy 1,000 contracts. The price movement on a contract is basically what we call 1 pip. Okay. So when currency prices are quoted, they're quoted to 4 decimal places. And the very last decimal place, so 0.0001, that would be 1 pip. And 0.0002, that would be 2 pips. So we call the decimal places pips. And when we look at hedging and managing risk in your portfolio, it makes sense to think of the decimal points in pips. And then also with the standardized futures contracts and also the options contracts, there are specific maturity dates. So unlike the OTC market, when you can trade to any date that you require, there are standard dates in December, September, June. So every quarter, you've got a trading date. And then also, unlike the OTC market, there's a margin that's required upfront, and that margin is calculated based on the size of your trade, and that's also to cover, credit risk of people transacting via the exchange. So if we have to now look at the futures contract versus an FEC, so the futures contract is like an FEC that's traded via the exchange. That's another way to think about it, where an FEC is traded over the counter, or we call it the OTC market. The futures contract is standardized, so therefore it would have specific maturity dates, whereas an FEC has flexible maturity dates. So you could basically trade to whichever date you require for your transaction. And futures contracts, because they're standardized, they come in specific contract sizes. So as we said, contract size, apart from the maxi contracts, is equivalent to 1,000 units of a particular currency. Whereas with FECs, you can trade any size. And then the one big difference is that with FECs, there's a flow of foreign currency at the settlement date, whereas with futures contracts, everything is settled in rands. We're going to look at a brief example of how that is done, but it's a net cash settlement in rands. So at maturity, you won't get any foreign currency into your account, you will get rands. Now let's look at an example of cash settlement of a long dollar-rand future. So long is some more financial market jargon for buying. So if you buy a currency, you are long that currency. So if you buy dollars, you are long dollars. So if we look at this example here, where you've secured a futures contract rate at a dollar-rand rate of 11, that means that, so now you are long, which means that you are buying dollars. So if at maturity, dollar-rand is trading at 13, you've secured a contract to buy at 11. So you're actually doing better than the market, because everyone who's trading at spot has to buy at 13, but you've got a contract to buy at 11. But because there's rand settlement and not a flow of foreign currency, what then happens is that you take the difference of the 11 rands where you've secured your contract and the 13 rands where the spot is, so that's a difference of 2 rands. So if we look at one contract is equivalent to $1,000. So 2 times 1,000, that's 2,000 rands. So the difference between the 13 and the 12, that's the net, is 2 rands times 1,000, gives you a net cash settlement of 2,000 rands. So you will receive 2,000 rands. But now if the rand had to move in the opposite direction, which is not in your favor, where the market at spot is buying at 9 and you've got to buy at 11, then what happens then is you have to then pay the difference. So the net is the 11 minus the 9, which is equal to 2. Per contract, you times it by 1,000, so that's 2,000, which means you now have to pay 2,000 rands per contract. So if we look at another situation where you are short dollars, so which means now you have sold, what are the implications? If we look at, again, a contract rate of 11, if at maturity, dollar rand is trading at 13, which means instead of being able to sell at 13, you've now have to sell at 11. It means now the market has moved against you because you're selling at a lower price to where the market is. That means then the market has moved against you, and the difference between 11 and 13 is 2 rands per contract times 1,000. So that's 2,000 rands per contract that you've got to pay in. Whereas if you were selling dollars, or you've got contracts to sell dollars, and at maturity the rate is at 9, which means the market sells at 9, but you've secured a more favorable rate, a higher rate where you're selling at 11. The market has now moved in your favor. So the net cash settlement in rands is where you take 11 minus the 9, gives you a difference of 2, times by 1,000 rands per contract, which means per contract you'll be receiving 2,000 rands. And that is how the net cash settlement works in a nutshell. For more information and more worked examples, do go online and download the manuals, and you can work through some more examples. Thank you.